In this chapter, we focus on stockholders' equity. Specifically in this video, we'll be focusing on equity versus debt, benefits of corporate ownership, benefits of equity, what makes up equity, and stock terms that we'll utilize later on in our journal entries and financial statement creation. Starting with equity versus debt, remember that a company has two ways in which it can finance its business. It can either finance through equity or through debt. Each has its own advantages and disadvantages. For instance, equity doesn't have to be repaid. Dividends are optional. But equity financing gives up control. It splits ownership and gives new stockholders the right to vote and share in earnings. Debt, on the other hand, does not split ownership. Its interest is tax deductible, but it's required to be repaid not just in principal, but also with interest. There are other advantages and disadvantages that we could attribute to both equity and debt, but the important point here is to get a general understanding of what we mean when we're talking about financing regarding equity. You can see that equity financing is not required to be repaid, has the potential for dividends, although they're not required, and it splits ownership in the company. All of this will come into play when we start to do the accounting for this type of transaction. In general, when we talk about equity financing, what we mean is that a company is issuing shares of stock in exchange for capital so that it can grow or build its company. Remember that many of the benefits that we outlined regarding the corporate form of business in Chapter 1 revolve around this idea of equity financing. For instance, you can purchase shares of stock in small amounts. Stock or ownership that you purchase is transferable. And thanks to limited liability, you can only lose the amount of money that you put up for the purchase of the stock. In other words, you're not liable for corporate debt. Beyond the benefits of the corporate form of business, there's also specific benefits attributable to equity ownership for the investor. For instance, holders of the most basic form of stock, often known as common stock, usually get the benefit of voting rights, which allow you a set number of votes for each share that you hold for major issues that might be brought to the attention of the owners. Common stock shareholders often get to participate in dividends as well, which we learned from an earlier chapter are distributions of retained earnings to shareholders. Remember that dividends are optional. Not all stocks declare dividends, but those that do, common stockholders typically get to participate in those dividends. Common shareholders also typically get to participate in what we call residual claim, which is where if a company ceases operations, stockholders share in any assets remaining after creditors have been paid. In other words, equity is subordinated to debt. The debtors get paid first, but then equity, common stockholders, get to participate in the distribution of the remaining assets, i.e. the residual claim. Finally, in order to retain their ownership percentages, existing stockholders that own common stock may be given the first chance to buy newly issued stock before it's offered to others through preemptive right. This allows a current common stockholder to avoid the dilution of its current percentage of ownership by an issuance of new shares. Imagine if you owned 100 shares and that represented 10% of all the shares outstanding, and then a company decided to issue 1 million new shares and you didn't get the option to buy any of those new shares to maintain your ownership percentage. Obviously, your percentage of ownership with 1 million new shares issued and you only have 100 would be significantly diluted. So this is what preemptive right affords as a benefit to the common stockholder. Keep in mind that not all common stocks come with these rights. These must be defined in the Articles of Incorporation. For instance, Facebook and the original founders of Facebook offer an interesting case study regarding preemptive right, where one of the original founders' ownership percentages were significantly diluted through subsequent transactions when a new company was formed and additional shares were then issued. So the important point to keep in mind is while these rights may be common, particularly in certain states regarding ownership for common stock, they must be declared or identified in the Articles of Incorporation to ensure that they actually exist. Not all common stock comes with each one of these rights. While we've been focused on discussing stock, and stock does make up a portion of stockholders' equity, it's important to understand what all components exist in stockholders' equity. Remember, when we refer to stockholders' equity, we're referring to the right-hand side of the accounting equation here, and specifically this component. We can break this out into several different pieces. For instance, we could break it out into contributed capital, which we've been referring to as common stock throughout this course, but that's only because that's the most basic form of contributed capital. We're going to find as we progress that there are several components here. We also have retained earnings as a piece of this. And although we have not discussed it, there's actually two more pieces that exist as stockholders' equity. One is treasury stock, which is a component of stock, but it's a contra stockholders' equity account. And then we have AOCI, which is sort of like retained earnings, but it's for what we call other comprehensive income. This component right here is not something we'll discuss in this class. It will definitely be something that's addressed in the intermediate accounting courses, but it won't be something that we address here. We will, however, focus on these three components. Contributed capital represents contributions of capital from investors. Namely, it includes common stock, which we've utilized throughout the semester. It includes preferred stock, which is a particular type or denotation of stock, which we'll talk about in subsequent videos. And it can include additional paid-in capital, which we often refer to as APIC. Now, we'll talk about that account as we start to build upon concepts in this chapter, but additional paid-in capital is basically the excess of the capital contribution above what we call par value. We know that retained earnings is made up of net income and dividends, and that we can further break down net income into revenues and expenses. And finally, we have a new contra stockholders' equity account called treasury stock, which is where a corporation repurchases shares that have previously been issued to stockholders and holds on to them for various different purposes, including to send a signal to investors that the company itself believes its own stock is worth acquiring, or perhaps to reissue the shares for payment of future services, or perhaps to reissue the shares to employees for stock option plans, or perhaps simply to just reduce the number of outstanding shares that are currently in the market in order to increase various different measures like earnings per share. This is how these components of stockholders' equity might be shown on the balance sheet. So you have the stockholders' equity section here. This is a component of the balance sheet. You've got contributed capital made up of preferred stock, which again is a particular type of stock that has specific attributes. Common stock, which is our basic type of stock. Additional paid-in capital, which is the excess contribution above the par value of common stock, which we'll talk about par value here in a minute. Retained earnings, which again is the net income and dividend components. Treasury stock, which is a contra stockholders' equity account. You can see it in brackets here. And then accumulated other comprehensive income, which again, this is not a component that we'll discuss in this class, but it will be discussed in future accounting courses. It is the accumulation of other comprehensive income transactions, similar to that of retained earnings for net income transactions. The final topic we want to address in this video is a few stock terms that will help lay foundation for future calculations and journal entries. First one is authorized. Authorized shares indicates the number of shares that can be issued. Issued shares represents the shares of stock that have been distributed by the corporation, and it includes both outstanding shares as well as treasury stock. Outstanding shares represents shares that are currently held by stockholders who are not the corporation itself. Treasury stock are issued shares that have been reacquired by the company or the corporation itself. And finally, par value, which is not a type of share, but it is a concept that's going to be utilized in future journal entries that we do regarding common stock, where common stock is par value. First, know that par value is sort of an archaic term. It long ago had a meaning where it represented a floor for the minimum amount of price for contributed capital that could be pulled out by shareholders. Now we have stronger laws that sort of avoid that issue or at least address it in another manner. So par value has lost a lot of its meaning in that respect today, but it's still utilized where we have states that require a par value for one reason or another in the journal entry process. You can think of par value as an insignificant value per share that's not at all tied to the market value per share, that is specified in the corporate charter and is used as an input in the calculation needed to credit common stock, the account common stock, when stock is issued. And this will be addressed in a subsequent video when we start journalizing the stock issuance process, but I wanted to make you aware of that concept. Remember, not all states require par value. So you could have common stock with no par, or you could have common stock with par. And when it does have par, that par value is going to be an input to the calculation of the credit of common stock. And this will be made clear once we get into the journal entries. Here's visualization, how many of these terms fit together. Again, authorized is the number of shares that could be issued. Issued shares are the number of shares that were distributed. It's made up of both outstanding shares and treasury stock shares. Thus, outstanding plus treasury stock equals issued, and you can manipulate that equation any way you'd like.